This page lists down in our mind the key principles on which profit monks, investment newsletters, algorithms are built on. And those principles, we will not spend a huge amount of time on those, but at least conceptually I wanted to throw them out to you in this chapter before we go to more practical matters. um, so it is this: number one, trade often. So trade a lot. The only way to be consistently successful in the trading business is to continue to trade and continue to trade small positions. So we'll discuss asset allocation a little bit. Trade trends. Okay, so this is very important. If you remember, just 2 chapters ago we looked at the fact that the newsletters strategies for Swing Plus or Milestone Plus both, they did not do as badly as S&P 500 and the general stock market and individual stocks in 2008. Why? Because it trades trends and it keeps cash in hand. Trade optimism. Okay, I don't have to repeat it because this is a buy side um, uh, investment newsletter. Now think about that. There is another way to look at it. The world has always improved over a long run. Now, there have always been periods like 2008 and 1933 and Black Friday in 1987, or was it Black Monday? I can't even remember right now. And this, so there are always those dark periods, Black Swan events and whatnot. But in general, it's always a good strategy to believe in the human ingenuity, to believe in the hard work and innovative capabilities of people who are working hard in all those companies you are investing in. So trade optimism and trade trends. Most important, don't go broke, don't be greedy, don't invest a lot of money in a trade just because you think it's going to be that one trade that will change your financial status. That is never going to happen. So don't go broke and go back to trade often and trade small positions. The last one, trade fat tails. I think I'm using too much of a probabilistic statistical terminology here, so I won't spend a lot of time in this scenario. But just look at one thing that might be interesting, which is let's look at just one particular example from the web page, and that will clarify what fat tails means. So let's look at this one, the first one, or randomly. Okay, so let's pick this guy. So what's happening here is this: the advice, the information is to buy call option for Michael Kors at strike 72.5 for around $4. And what is the stock price? It's 69.06 at that point. So that is this column. So 69.06. So what the strategy is doing is to buy out in terms of where it thinks there is a good chance of making a fat profit. Why is that? Because typically, and you can search a little bit more on what fat tails means, etc., in terms of price spread and option spread. We won't go into the technicalities of that, but typically markets have the tendency to price options which are out of money, OTM, slightly cheaper. So what this means is that there is potentially a trend going in favor of Kors with whatever the algorithm has come up with. This is for Swing Plus, I believe. This is for Milestone Plus. So Kors is going through a good trend, and it is right now at $69. And the idea is to buy the option cheap because it's part of the fat tail strategy, the option at 72.5, you have a better chance of getting it at $4.15. So that's the meaning of trading fat tails. So don't worry too much about that, but at least that gives you a fundamental idea about where the profit monk algorithms are coming from. So let's consider two practical questions. The first of all is asset allocation and diversification. So how much to invest in what strategy? So my suggestion is this: first, pick your strategy and stick with it. Don't go and try to invest too much money and run across a strategy. So let's say you pick Milestone Plus. Why? Because you think you have to make fewer trades. In fact, let me share a secret here. So if you go to your account settings here and change this setting, we have never talked about this before, but let's say you change this setting right to the leftmost. This was rightmost, now leftmost. So you have done this setting, you see this changed, and once this happens, once you go back to the Milestone Plus page, the number of trades that you have, you will get, will go down even further, because what that setting does is it gives you cheaper and cheaper trades. So it sets the threshold lower, and so you can only make fewer trades. I don't even know whether KORS will still be there. See, yeah, so the course is gone on. Okay, so let's try to get course back up by changing the strategy a little bit. Let's say here to here. Okay, let's see what happens. Now we are setting the threshold to 5%. Go back. No, it still didn't work, so I have to change a little bit more. So let's say 5% to 6%. So it changed. I just want to ensure that the course thing is in front of us. Okay, so I think we got it back. Okay, no, we did not. Okay, so you can play around with this strategy as this setting as much as you want, and then what that does is it changes the number of trades that appear on your personalized screen. And so coming back to the original topic, which is asset allocation and diversification. So step one, choose a strategy. So let's say you pick Milestone Plus, because for a certain setting you have to make 300 odd trades over 1 year. Or you like Swing Plus because you are a more active trader, you are making closer to 400 trades every year, or you choose both. Okay, so you can do either, but once you pick a strategy, you have to stick to it. So it's a function of how much money you are committing to a particular strategy. So my suggestion in this scenario is always to pick one strategy that you like for the settings that you like the most, and then stick to it. Now, then what? The first question, how much do you want to invest in one trade? And you have some of this information in an article here on the web page as well, in Investing Thought region. So you can click on these articles and you will get more information. But for summary, maximum investment in one trade, and I think I will probably even go more conservative. Rather than 1/20th, probably it should be 1/30th or less. So if you are looking at $10,000 of total commitment to a particular strategy, do not go beyond $300 to $400 is my thumb rule per trade. So that's the amount of money you invest in one trade. So now how does that work? So let's go back here. Let's go back to the Milestone Plus strategy and see how that plays out. So now if you are only investing $10,000 and your limit you have set to 400, you will not be able to invest in some trade. So for this trade or this trade, because this is beyond your strategy, so beyond your limits that you are setting. So either you increase your limit a little bit or don't invest in more expensive stocks and options. So now to keep the whole investment strategy balanced, let's say if your limit is $500, when you are spending in Yum, which clearly didn't do too well in last few days. But let's say if you are investing here, you would buy three contracts of yum, which will take you to about $480. But you will just buy one or two contracts for PSX, and you will probably not even buy Humana Incorporated HUM because it's um, beyond your target. So that's the first question. Now the second question, which is about asset allocation. And this is not a science, this is more of art. This is also a function of once you start investing how the market goes. But typically, let's say if your total starting portfolio is 10 to 15,000 US dollars, let's say 15 for argument's sake. So in phase one, you go maybe about $400 per trade. Gives you an ability to invest in about 25 to 40 trades before the money starts to come back to you from the previous trades, and then that you can invest in subsequent ones. So in this time frame, you are investing a large part of your portfolio in the market. Now when you go to phase two, which is 3 to 6 months, or whenever you have, let's say your 15,000 has become 20,000 or 25,000 or 30,000 or whatever that number is, you start to hold some cash reserves. Okay, and when you go phase 3 long term, and when your portfolio has exceeded, let's say $50,000 at some point of time, maybe it's 1 year out, maybe it's 2 years out, depending upon how the market does, then you invest $1,000 or more per trade, but don't forget to hold 50% or more in cash reserves. So that is how you do asset allocation. Now when I say cash reserves, you might argue that, okay, I could do something safer. Yeah, sure, you can hold it in gold, you can hold it in currencies, but at Profit Monk, we like to hold cash reserves in dollars and euros and in good currencies. So that's how it's up to you whether you hold cash reserves or whether you hold that money in some other safe instrument. But it's always better to keep a lot of money in cash at all points of time. Why is that? Okay, so don't forget this picture. I think it's also here on this web page, so don't forget this picture over here. Lot of green, a very little orange, and that's what enabled. So the green is again the dry powder, cash in hand, and having that green cash in hand allowed the strategy, the investing process to not drop down too much in 2007 to 2008. So that's the advantage of having cash. So don't invest all of your money, don't be greedy. Of course you have to invest a lot more at this point when you are starting, and this says 2003, but let's say if you are starting now with $15,000, your portfolio would look like this. But as you go through, you can increase a little bit, but don't forget the big green. That's the key to the principle of don't go broke.